Good afternoon, everyone. We are getting ready to get started. We're expecting around 69 people, I believe, was our final count for registration. I know that not everyone is on yet, but in the interest of time, because we have a lot of content to cover, we will get started. So if I can get my screen to cooperate. We welcome you to the Regulation and Rules Roundup, Costing Wine. This series of educational events addresses regulatory issues specific to the industry, as well as general business issues. Regulation and Rules Roundups are provided at no charge for gold and silver members of the Virginia Winegrowers Association. For more information about VWA member benefits, visit our website at vawine.org. Feel free to ask questions during the presentation. You are probably not the only one with the question, and it may open the door for other questions. Wait for a break if you like, or raise your hand, or enter the question into the chat, and we'll try and address those as time allots. And additionally, we are recording this presentation. The recording will be sent as a follow-up in an email for everyone who is registered and posted on the website for download. You should have already received the materials for the event. If not, we will be sending those as a follow-up as well. And please be sure to mute your mics if you are not a speaker. Our speakers today are George Hodson. He is the Chief Executive Officer of Veritas Winery, co-owner of Flying Fox Winery, and president of True Heritage Winery. George is an active voice in the promotion of Virginia wine and advocate for equity and inclusion in the wine industry, and remains committed to advancing the quality and reputation of wines produced in Virginia. Zane Stevens is the director of Protea Financial. They provide business owners and managers with financial information and insight for making decisions. Protea specializes in removing burdens and responsibilities of finding, managing, and training an accountant or bookkeeper. That would be a relief. They can provide any combination of standard bookkeeping and accounting, either as a fully outsourced service managed by Protea, or by adding a dedicated full-time or part-time accounting professional to your team at a significantly lower price than what you would pay to hire an accountant or a bookkeeper. There will be a survey with this event. Again, this is supported with grant funding, and therefore we do greatly appreciate your feedback and support in completing the survey. That goes a long way for us reporting. So with that, I'll turn it over to our speakers.
All right, thank you, Lori. I'll go ahead and jump in. And so wanted to kind of give the context as to why we thought it'd be a great idea to have this specifically as a reg roundup discussion. And I think it's in the face of kind of where we are in this moment of emerging from a global pandemic and seeing a lot of economic forces happening around us, and then the ultimate impact that they're having on our business. And so I think we can all recognize that we're seeing all of our pricing going up as we talk to our vendors, as we talk to people handling shipping, and as we're kind of going through what we're doing on a daily basis. And there's also been kind of a period of time for the last 2 years where we've just been kind of holding our breath. And so we wanted to take this opportunity to create the context for a discussion about costing the wine, understanding what we should be charging for our wine, and kind of avoiding some of the pitfalls that can be associated with kind of being so busy doing our jobs. And I think that that's one of the harder things about our industry, especially with a number of our smaller wineries. They don't have the infrastructure, they don't have necessarily an accounting team. And so that's why this partnership with Zane and his expertise is particularly beneficial, because we need to be able to take a step back and actually run our business as opposed to just picking grapes and kind of surviving. And we've been doing a lot of surviving for the last year and a half. And so the basic format today is that Zane's going to kind of go through a more technical explanation of inventory costing and determining your costs. And then we'll kind of talk through some of the situations that we deal with in terms of Virginia specific sales models. And then we'll talk, hopefully we'll have some good discussion. So definitely invite some questions. But we will go through these things and try and identify kind of maybe some best practices, maybe some good ideas that other people have had, maybe some new viewpoints that others haven't. So a lot of it's going to feel basic, a lot of it's going to feel complicated, but hopefully you can find what's valuable to you and your winery. So with Zane, I'll turn that over to you to kind of come into your presentation, and then we'll work through maybe a couple of examples and questions as we go through your presentation.
Yeah, great. Thanks, George. That's a really great introduction. When the VWA reached out to me to do this topic, cost counting generally is really close to my heart and one of my passions. And being able to give this information and help wineries is sort of what we do. So introduction of myself. My name is Zane Stevens. I'm the founder and director of Protea Financial. We are an outsourced bookkeeping and accounting firm based in California. We were formed in March 2014. So we're going on 8 years. Prior to that, I was a chartered accountant in South Africa. I spent 4 years at KPMG with a focus on retail, industrial, and automotive. I, definitely touched a lot of cost accounting in the automotive space, and I've taken a lot of those learnings from how the automotive industry look at costing and brought those concepts to the wine space to allow my clients to get the best answer in terms of what their wine costs. After my time at KPMG, I was a financial controller for a listed company subsidiary. I had a team of accountants of 25. And like I said, we've been doing wine accounting for 8 years with the formation of Protea Financial. A little gap in between that, I was doing exit strategies for wineries, sort of going in and saying that this is where we are right now, what it will take for the owner to exit. The wine costing space is an interesting space as it can be what seems like a very technical topic, and cost accounting in its core is a fairly complex section of the accounting world. So when you sort of break it down and you just sort of look at that bottle of wine in front of you, it actually becomes fairly simple to understand what you should be looking at when trying to understand what does that one bottle of wine cost me. And if I know what that bottle of wine costs me, am I able to understand then what I need to sell it to be able to make a profit and be able to cover my overheads. So if we just sort of roll through the agenda that I want to cover today, we're going to, all of these sections, we're really going to just go high level and look into, what is inventory costing, the evaluation, what's important to do, why is it important to do evaluation of the inventory, the different types of inventory, the steps to follow in preparing inventory. We'll do a quick recap and then hopefully have lots of questions. This is a section where, it's a topic where I could, I originally sent through my slides and there were 33 slides, and the presentation that I originally worked out was about 4 hours. So, there's a lot of complexity that we could go into, a lot of specifics, and then there's just so many different ways that people make wine, right? You can buy bottled wine, you can buy bulk, you can buy grapes, you could be farming your own, you could be importing, and each version of that has their own specific costing. So we're going to try to generalize this a little bit to just look deep down at what that bottle of wine looks like and where those costs from and what you should be considering when putting that into the cost of your bottle of wine so you can make better decisions. Fundamentally, what we're trying to achieve when we're looking at costing is, what comes into it. And, one of the things that I talk to my clients about, and a lot of people really don't particularly like to hear this, especially in the wine industry, because I know making wine is an art. But when you dig through all of that, at the end of the day, this is just purely a manufacturing process, as if anything that was created in a factory. And when you're looking at that from that standpoint, and if you just forget about the nuances of making wine and the art that goes into it, it's sort of pull it down to, hey, I'm making this widget, I'm making, this cell phone that I'm talking on today. Like, what are the costs involved in making that piece of equipment, in this case, a bottle of wine, and how do we bring that all together to understand what the true cost of it? When I'm looking at inventory valuations, and a lot of the time when we're working to client for the first time, we do run into all the same specific problems. One of the number one key answers when I speak to people, they go, I know how much my wine costs. But really, that's not knowing what their wine costs. They think what they know what their wine costs, and that is just using assumptions on gross numbers that they're paying for different products. It sometimes gets them close, but a lot of the time they're just forgetting about some of the important items that need to be added to that cost of a bottle of wine as well. Another issue that we tend to run into is their tax CPAs are doing their costing for them, and that's great, and the tax CPAs are probably doing a great job, but it is important to remember that for tax purposes, there's only a very limited amount of items that you have to think about that need to be capitalized for taxes. Your tax person is not trying to help you run your business the best possible way or make the most profit on that bottle. All they're trying to figure out is how do they save you the most taxes. So using a tax CPA costing in a pricing decision is not always a good idea. And then the most common mistake that I see is, okay, I make 5 different SKUs. I'm just going to throw all of that into one barrel, divide by the number of bottles I get, and that's the cost of my wine. Not taking into account any of the factors that, different grapes cost different prices, different glass cost different prices. Some of them are aging, some of them are not aging, and there's different costs that need to be incurred through that period of time. So when we're looking at the cost of inventory, we want to be looking at all costs and not just the hard costs. So when we're looking at a manufacturing process, we're looking at your direct materials, your labor to make that product, as well as any, quote unquote factory overheads. So what are the costs to run that winery to be able to make that bottle of wine? All 3 of those costs need to be considered when calculating your final cost of your inventory. There's also costs when you're thinking about it from a selling point of view, that there's additional costs that have incurred once you do sell the bottle of wine, which is selling expense and administrative costs, which will determine your true gross margin or your net profit on a bottle of wine. We're not going to go into that today. We really are just going to focus on those manufacturing costs and how those come together in sort of pricing a bottle of wine and understanding the cost to make good sales decisions. We can move to the next slide. So we spoke about those three main drivers of cost: your direct materials, your direct labor, and your manufacturing overheads. I think from a direct material standpoint, it's fairly easy to see, and the picture that's been added there of the wine bottle anatomy that we all really understand gives a great breakdown of what costs you should be considering. So it's not just the juice that's inside that bottle, but it's also the glass, it's the label, it's the closure, it's any cork, any specific, I've got clients where they're doing etching on their bottles or screen printing on their bottles. It's all those costs that need to go into that cost of that bottle of wine. And at the same time, when you're thinking about those dry good costs as well, you need to consider are these once-off costs or these costs that I can use over and over? Generally speaking, glass is something that you can use vintage after vintage after vintage. But when you're looking at labels or date-specific corks, those most likely can only be used in one vintage. So if you've got minimum order quantities that could affect the cost of your products, hey, maybe you bottle 2,000 of that product, but you've got a minimum order quantity for your labels of 5,000, that cost of that label doesn't cost you what the price of one label it is. It really is the total cost divided by 2,000. So when you're considering those costs of those dry goods and your material costs, you also need to consider what breakages you have and how that adds to the cost of each single bottle of wine. Those types of, especially for small producers, those types of decisions on minimum order quantities can have a big effect on what you believe your cost of wine is, because a label that you think is 20 cents is all of a sudden 45 cents. That's a significant difference when you're selling a $15 bottle of wine. and those little things all add up pretty quickly. So it's something to remember when you're trying to price out your wine. It's not necessarily a unit cost, but taking into account all the costs involved in that for that unit. If you're buying grapes, it can be fairly simple and understanding that I bought these specific grapes that are going into this specific bottle. But specificity, that's the word, right, is really important when it comes to these grapes. Different grapes are going to cost you different prices if you get them from different producers. They could be costing you different if you're growing them yourself. And understanding, rather than just throwing all those grapes into one barrel and saying, okay, my different SKUs cost me on average X number of dollars, going, well, that's a more expensive grape and it's going into this bottle. I need to take that more expensive cost per bottle and bring it in, so I get the true costing of that individual bottle. Again, the direct materials are the easy part. I think these are the parts that we all think about when we're looking at a cost of a bottle of wine, and understand that those are the things that we need to add up. And generally speaking, when I speak to anybody in the wine industry, these are the costs that get put on the piece of paper before we get in there and do costing. These are the easy ones, right? We can see it, we can hold it, we can touch it, and everybody remembers it. It's also the ones that you are expected to capitalize from a tax CPA standpoint. So it's also the one that people believe that's the true cost. Unfortunately, it's not all of it. It's just a part of your cost. And the other two that we have mentioned is direct labor as well as manufacturing overheads. These ones are you have the cost. You need to pay for your winemaker. You need to pay for those harvesting terms, the assistant winemaker. You're paying for those people. But what's important to understand that their cost needs to be included in the cost of your winemaking as well. One of the big things where I think newer wineries sometimes miss out is if their winemaker is also the proprietor and there's no salary being paid, and sometimes that cost then equals zero on their books. But in reality, there is a true cost of that person's time, and that's something you need to consider as well. So the cost of your labor to manufacture a bottle of wine does need to be included in the cost of your winemaking as well. Generally speaking, the process of bringing that cost of labor in is going, where was my time spent? If it is not very specific where my time was spent, let's allocate it to all bulk wine that we have on board and allocate that on a monthly basis based on the monthly salary process. We see those people, we understand those people, we know their role. So again, this table really is working from the most obvious ones that most people include down to the least obvious ones, which people sometimes forget. Understanding that you need to bring the cost of people in does make sense to a lot of people. They get that those are the people touching the wine, making the wine, bringing it all together. Those are the people, that's sort of the difference between a factory and the art of those people. But at the same time, if you're gathering a widget, you're including the cost of the people on your manufacturing line to bring that widget from raw materials through to a finished product. So it's the same process, yeah. The allocation of people's salaries need to go to the cost of that wine, and that needs to be brought to the cost and needs to be remembered when you're trying to calculate the total value of your wine. The last portion of it is the more tricky portion, and this is what are the costs involved in keeping this manufacturing facility going. So this could be the rent or the depreciation or the amortization of the building. It's the equipment that you have, so the tanks, the barrels. It's power, water, somebody coming in to clean the facility to make sure everything's in line. It's all those hidden costs of running the facility. If it's sort of what are the costs to keep this building going so that I am actually able to manufacture this bottle of wine and get it from grape to store. But thinking about all those costs to effectively keep the lights on need to be included in that as well. And an allocation to your bulk wine needs to be made through the manufacturing process on a monthly basis, and they will add up each month. If you take into account, you've got your manufacturing overhead, your direct labor, and your direct materials, and you add those three costs together, at the end of the process, once it goes into the bottle, and remembering the cost to get that juice into the bottle, the whole bottling process needs to be included in the cost of your wine as well, and you add all those costs together, you get the true cost of your wine. What you'll quickly realize is that if you just looked at direct materials, it would be a significantly lower number than adding direct materials, direct labor, and manufacturing overheads. And that gap between materials and total costs is a lot of the time where we see people run into a lot of issues because they feel that they have more margin to give away than they actually do. And that's the times when people are like, well, here's a free bottle. Like, I've got enough margin to play around with this. In reality, they don't, because those costs are living in direct labor and manufacturing overheads. We move to the next slide.
Zane, could I just jump in, just to, I think that was a really important spot just to pause for a second and
Sure.
see if anybody kind of has any questions about any specifics. I mean, I think that, and we all inherently understand that, everything it takes to sell a bottle of wine needs to be included in the cost of that bottle of wine. And I also think that you made a really interesting point just then about those comp bottles, right? Because as we're working through the total cost, we're creating that numerator, we're creating the total cost, and then we're dividing it by the number of bottles we have. Every comp bottle that we change our denominator by is going to have a pretty big impact on kind of what our per bottle cost is, because those costs don't change with every bottle that's given away, but it divides it. So I wanted to kind of hit on that point as something that is kind of hit our radar recently, and see if anybody had any questions about, like, that person who's mowing the grass in order to make it look really pretty on a Saturday so people come and visit. That has to be included. So does anybody have any questions before Zane moves on to his next slide? You did a good job then, Zane. You nailed it. So
either I did a good job or a terrible job, and everybody's like, I don't know what this guy's talking about. But yeah, George, I mean, I think there's a lot to say about what you were bringing up there. And, one of the things with accounting is that cost of those samples, those free bottles, do sort of disappear into the overheads a little bit. By definition, it's a selling cost, and it ends up in the overheads and not in the gross margin. And I do think when we show people gross margin and then true gross margin, which is, that gross margin less samples, distribution allowances, whatever else it could be, that those tasting room bottles, all of that, and they then see what their true margin is and what that true gross margin percentage is, it can be frightening at times, because it adds up so quickly. And a lot of the wineries that we've taken on board where we've seen struggles is that sample percentage is like 5, 6, 7, 8%. And that's just eating, straight into your bottom line. That's, if you think about your inventory as cash, it's literally just taking the cash and throwing it in the air and hoping something lands. And, one of the things I try to tell people who are looking after inventory, and this, this might help everybody who's got somebody looking after their tasting room, and, we're always losing bottles because we don't know where they've been, or how many have been used in tastings. If people think about inventory as real cash, and people are giving me cash for cash, you sometimes get a little bit better control of it, and that sample allowance generally shrinks pretty quickly because people see it as money straight out their back pocket. So this slide over here touches on a lot of why it's important to do valuation of inventory, and there is a lot of accounting talk, and no hiding, I am an accountant, as boring as they come. My wife calls me a robot in general, most terms, because I'm pretty emotionless when it comes to these things. But for everybody on this call, what's really important, other than figuring out what your profits are and how much working capital you have, and is it in terms of GAAP or IFRS, like, who cares, right? The most important part over there is that very first line. And I'm going to read it out because I think it's such a good sentence, and it really drives home why this is so important to your business. And it says, inventory valuation assists in making informed decisions. For example, the selling price, profitability of the product. So getting your price right and understanding what it costs you, this process, which just seems like this tedious accounting process, they've asked me so many questions, like, I really don't care about it. It should be so important to you as a business owner, because getting that cost correct helps drive prices. And the number of people that I've come in and asked them, like, how do you choose your price? Well, they're like, well, I know it costs me $10 to make a bottle, so I'm going to sell it for $20 a bottle. And then we get just direct material. And then you add the labor and you add the overheads, and all of a sudden it's $15 a bottle, and they're selling it for $20 a bottle. And, you know, there's not a lot left to play with in terms of selling costs. So out of everything that I could say to you, when it comes to inventory costing, the main reason we do it, and the main reason I take it so seriously, is that it's going to drive every decision that you make about wine. And this is even more important in the environment that we're currently in, where prices just keep escalating and keep growing. I mean, the cost of glass keeps going up. The likes of Constellation keep coming in and buying glass out from underneath my clients on a daily basis, and they have to pay more for that glass because they're having to almost, express ship it to themselves. So these costs just keep going up and up and up and up. And if you don't have a true sense of what that product is costing, you just cannot make good business decisions. You cannot run your business correctly, and you're going to get into trouble in the long term. Yeah, I see there's a question from Deborah Ring, and that's all a note from Deborah, and it is a really good note. And if we take it back to the growing costs of your grapes, and if you've got your own vineyard and you're growing, obviously vineyard costing is a very specific world, and it does create some complexity because agriculture, which they'll see vineyard as, can do cost accounting. But what we'd like to sort of focus on is that 12-month cycle, like the day after harvest, whatever you set that in. We'll normally pick a date. We'll call it October to September or September to August. Every cost that you spend on that vineyard over that 12-month period is adding to the price of your vintage. So if you're sort of in the process of picking now, you're ending, say we pick October 1st as the new growing cycle for the 2022 vintage, every single cost you spend from October 1st to September 30th next year is adding costs to the cost of those grapes. So if you want to do something special and you need extra, also you need nets for birds, like the spraying, the weeding, the trimming, everything you can think of that touches your vineyard will add to the cost of those grapes. And if it's something different this year and it's cost you more, well, those grapes are going to cost you more this year. Or if you've had to reduce your yields, or it's a bad grow and your yields are down, well, that average cost of grapes, even year on year, your cost could be fixed. This year it was X, next year it's X, but one year you've got more tons than the other. Well, the year with the lower tons, those grapes cost you more. And that's why it's so important to keep track of all these costs throughout the process, so that you understand when you get down to it what your per ton cost is, what your per gallon cost is, what your per liter cost is, and that will all get down into the bottle cost, which will give you the true reflection of what that bottle of wine costs you and what you should be able to sell it for. We can move over to the next slide. This is sort of a simple production flow chart that would give you a sense of where all of these costs come in. And we've spoken about direct material, the direct labor, and the overhead. You're going to have two sets of direct materials. One is going to be unused and one is going to be used in the manufacturing process. Though those will be, as I mentioned earlier, treated slightly differently. Glass, generally, you can use year after year after year unless you make decisions to change it. So you doing the count of that and putting it into your material inventory at the end of the year is great. Sitting on your balance sheet, that is something you can reuse. A label that says 2020 rosé on it, you're only got so much rosé, and once that's done, that unused inventory can't just sit on your balance sheet. That's just clogging it up. It's not a true reflection of that asset. That label is worth nothing at that point, and it needs to be absorbed into the manufacturing process. So if we're adding in the direct materials, your direct labor and your overheads through the manufacturing process, you'll get to 2 points. It'll either go into the whip inventory, which is unfinished. At that point, it'd be any of those dry goods, lying around waiting to be bottled, plus your juice sitting in barrels or tanks. That would be your whip inventory. While that inventory is in whip, it will continue to gather costs from direct labor and overheads. So while inventory is in whip, every day it grows, it gathers more costs. So if you're aging a product for 3 years, it will continue to gather costs for the full 3 years. It will take an allocation of labor and it will take an allocation of overheads throughout that process. So as it makes sense, generally speaking, wine that ages longer sells for more. It's the same, the process behind that and the thought behind that as well is gathering more costs. To be able to keep that inventory, in a tank for longer it costs you money, right? Somebody's got to make sure that that wine is in good condition. They've got to make sure that it's not, just turning bad in the barrel. Like somebody's got to watch it, and there's a cost to store it, as in any cost. If you're putting finished inventory into a third-party warehouse, well, you're paying for that inventory to be there. The same process, if you're keeping bulk inventory at your production facility, it costs money to be there. It's taking up space, and thus it's taking up resources and needs to continue to gather costs. The point is when these products stop gathering costs is when they convert from work in progress inventory through to finished goods inventory. Effectively, once we get it into the bottle and we're happy, we've closed it up, we've labeled, we've got the closures on them, that is the point in the accounting process where they stop gathering costs. At that point, we'll take into account all the direct materials, the direct labor and direct overheads that they've gathered over time. We'll take into account any bottling costs. We'll add all of those together. We'll figure out what that cost per bottle is, and it will move on your balance sheet to finished good inventory. And this is where you'll see what the value at cost price of your inventory is. Every time you sell a bottle, give a bottle away, just dispose of a bottle in any possible format, that's when it moves from the balance sheet as an asset, something that can gather value for you in the future, to your income statement as a cost of goods sold. And that will be offset against your sales at that time. So it's important to understand, the accounting people don't want me ever talking about it, but they call it matching principle. And we want to match your income for that sale of that bottle to the costs of that bottle at the same time. So every bottle that's sold, you should understand your cost at that point and be able to say, I sold it for $20 a bottle. It cost me $15 a bottle. Show the sale of $20. Show the cost of goods sold of $15. Your cost of goods sold at that point is increasing. Your finished goods inventory is decreasing. Really simple, moving from components through to something sitting on your balance sheet. And we know assets are good. They're intended to give the business value in the future, and then eventually that cost of wine will be expensed to your income statement, allowing you to complete the calculation of gross profit. And gross profit is that magic number we're all looking for. We're trying to maximize our gross profit to allow us to cover our overheads and at the end of the day have maximum net income, and hopefully that converts into cash, and that's money for your business. If we move on to the next slide, we can go into a little bit more detail on the different categories of inventory. So we spoke about all of these before, but just sort of breaking it down into some more detailed terms, and we use the word packaging material there. So another way to think of it is just dry goods, and it's separating those costs between your raw materials, which in this case would be your grapes, which will convert into bulk, versus your packing materials. And it's important to understand the distinction of those, because the raw materials are going to continue to gather costs while they're a raw material. So they will move from that raw material phase into the work in progress phase and continue to gather costs. So that distinction between the two products is so important, and understanding that grape and bulk is what's going to gather costs in the future, and they're going to gather costs being direct labor and direct overheads, and we're going to create allocations to those costs on a monthly basis on the best possible methodology we have. If you can be specific and be like, this cost was really for that vintage of Chardonnay, like, well, go and add those costs. If not, adding costs to your work in progress on a more generalized method is preferred if there is no specific costs that you can allocate. So what we would normally do is we'd look at the month and be like, we spent $10,000 worth of costs. We had 5 5,000 gallons of bulk at that point, 10,000 divided by the 5,000. That is the allocation per gallon for that month. And that gallon, that allocation to the gallons per month is what's going to drive your future cost of the wine that goes into your bottle. Packing material, on the other hand, does not gather additional costs. Once it's purchased, it really is the face value of the invoice that you paid for. So it'll be the cost of that invoice for the glass. It'll be the cost of the invoice for the closures, for the corks, for the label. And then, it's a bit of a weird one. It's more, we can throw it into the packing material, but it's the cost of bottling as well, which will eventually be allocated to the process, which is part of that. Bottling costs already just your conversion from whip to finished good process. And that's a manufacturing overhead at that point to sort of take it to that final form. Once you get, understanding your cost segregation, like this is important as well, because when you're looking at what the value of your inventory, it's important to understand what of my wine is already in a finished bottle, what is the cost of that inventory, and if I know what the cost is and how many units I have, I can understand what my future revenues could be. And the work in progress at the end of the day is just sort of, this is future finished goods that could become items that I sell in the future. Generally speaking, your work in progress has a lower value because there's less of a market for it. Might not be that true after 2020 out on the West Coast. But generally speaking, that process of converting whip to finished good is where the value to the third party is added. Me as a consumer is not going to go to the store and be like, hey, can I have 750 mils of that, barrel over there, just pour it into my own container. That sort of environment doesn't work. And I could get the greatest wine if that was the case. I would pay a much lower price than if it gets into that finished product, that beautiful bottle, that beautiful label with that wonderful story behind it. And that whole process of converting to work in progress finished good, that's where your value comes. That's where your value proposition, that's what looks, makes you different from others. I'm the worst. I'll go to a store, and what I do sometimes, if I'm not sure what I want to drink, I'll just try to find the prettiest bottle or the bottle that catches my eye. And that, for me, is going to create the value at that point in time as a consumer. So for the consumer, that process of converting to work in progress to finished good is where they find the value, which hopefully converts to value for you and future profits. We can move to what is my last slide. I'm probably not going to spend too much time on this one because it's just a lot of numbers thrown at everybody. And it sort of just breaks down what you would see on a set of financials in terms of costs and how allocations would go ahead. And you can see, if you look at the sort of table in the next to the red writing on the left-hand side of it, the allocation of remaining costs, where it breaks down some examples of costs incurred in a month, in this case, depreciation of equipment, some repair and maintenance, some winery supplies, some rental equipment, and then allocating those costs based on gallons on hand, where there's some great costs that are specifically allocated to vintage. You can also see with this example, this winery is not just making their own wine, but they've also got custom crush clients. So there's an allocation between their own costs as well as the third-party costs. So when you're allocating costs, you're not just looking at all the wine you're manufacturing, not just your wine. So if you are manufacturing for somebody else as well, you would be able to split those costs between those people. And that's also, a total side note when you're trying to price out those contracts where you're helping other people building your costs, understanding what your true direct labor and direct overhead costs are is really important as well, that you don't misprice that part of your business because that could catch up to you as well.
Awesome. So
yeah.
That's, I want to see if anybody has any questions at this point. I got a couple of questions to get your input on, Zane, but I wanted to see if anybody participating has any questions on the presentation thus far. You can just talk, unmute yourself, or you can go to chat. All right. Well, cool. Well, if you think of something, one of the things I wanted to ask you, Zane, and you having seen a lot of other winery businesses and a lot of, specifically West Coast and things like that. Um, I think one of the things that trips up a lot of folks, and even then when we start talking to our accountants outside of our business, is kind of our time lag in production and sales, and a lot of like kind of issues that creates, right? You kind of forget what happened 3 years ago, right before you release, this red. Let's say it's your, you've barrel aged it, you've bottle aged it, and you're getting ready to release it. And so there's a big time lag between the release of the product and the creation of the product. And so I think that a lot of people get kind of tangled up in tying the costs to when the sales are incurred, but then also pricing at the correct place, maybe 2 or 3 years after those grapes are harvested. So can you speak on kind of best practices there to make sure that people are maintaining their timelines on production and sales, and often the lag that occurs there?
Yeah. So, I mean, firstly, we have over, I think it's 95, 96 winery clients right now. So, we have quite a lot of experience, and we see a lot of books. We definitely see all versions of winemaking, from, people growing their own grapes, they've got the vineyard programs, to sort of people buying bulk in and manufacturing it, from there. What makes the wine industry really difficult is that time lag, from, especially if you planting your own vineyards, right? You plant that first vine, and it's 5 years before you even have anything that you can harvest, and then you want to age it, and it's 3 more years, and often 8, 9 years down the line before you even consider even selling it and releasing it to the market. It's very important, and ETB for one will help you out with this, that you have to report what gallons you have on hand. Tracking, one is, number one is get yourself a good accountant that's going to be able to track your costs on a monthly basis. Focus in on what it really costs me in that month for the production cycle, and don't even think about what am I manufacturing at that point, but rather understand, if I was producing, what costs am I incurring right now, and keeping track of that at that very point. And the same point then is, when you're doing costing, leaving it to the last minute, like, okay, it's been 3 years, now I'm going to sell, now I'm going to try cost my wine. Well, the costing process will happen at the point of bottling, but you need to find a system to track those costs through the cycle from day one. And keeping track of costs from day one is so important, because if it's just one vintage that you have on hand, it's pretty easy, right? Like, inventory costing is super simple. If it's one vintage, one varietal, it's your one SKU, and all you're doing is moving it through. It gets so much more complicated, because through this process of those 3 years from when you first pick the grapes to when you're selling it, well, you've picked again, and that's another one that's starting another cycle, and you've picked again, and that's in the cycle as well. So through the process, in theory, the production costs get lower as the more wine you have on board. But keeping track on a monthly basis what costs are incurred and allocating it to the various vintages is important. Accurate accounting records is important, getting it into the right accounts, making sure that detailed descriptions are added, and as far as you possibly can, adding backup information, add that bill, add that contract, like, make sure that is connected to the transaction. So if your accountant drops dead tomorrow, somebody else can walk in and go, okay, what was going on here? Anybody should be able to come in and figure it out, and then find a system to track those costs and the buildup of it. It's, we do it simply. We use an Excel spreadsheet, and it's really just like, these are the costs incurred, these are the gallons each month, and this is our allocation to that SKU. And just keeping that simple formula of, like, these are my direct material costs, these are my direct labor, these are my direct overheads, and keeping the track of it through the process is going to be important. It also helps, especially if you're 3 years out from selling that first bottle and you're trying to make business decisions. After a few months, you'll see sort of what the overhead costs you're incurring, and you can extrapolate that out and go, well, in 3 years, let's assume the worst case scenario, I don't make any more wine. Well, this is the cost per month. I know what my grapes cost me because I've already done that calculation. let's take that monthly cost times it by 36. Okay, this is what I believe my total cost will be. I know I'm going to have to bottle sometime in the future, so let's make a best guess on what that'll cost per bottle, add that information together, and it can give you at least a rough estimate of what that total cost will be in 3 years, so that you can make better decisions on the pricing of wine. Now, obviously, pricing is difficult as well, because you can make this beautiful wine, but the market, and once you add it up, you're like, oh gracious, this cost me $25 a bottle. I need to sell it for 50. Well, the market might say that wine, the best price you can get it for is 35. So there is an opportunity at that point to go, how am I going to reduce my costs? Do I sort of need to get cheaper glass? Do I need to refigure, like, I'm not going to put a date on my cork because that costs me extra money. So the sooner you are looking at the full detail of the cost, the better the opportunity to plan and make good decisions about pricing.
Yeah, great.
I hope I answered the question there.
No, you did absolutely. And I think that managing some of those customized things, I think it's very easy that can end up kind of becoming a cost trap for us, because we want to have kind of some of those details in the packaging that force us to really drive up a unit cost on something in the packaging that can't be reused. And as much as we want to have a dated cork in every single vintage, not only does it cost more to put the date on it, but then downstream you have to buy in smaller lots, and all of those economies of scale add up. But how about kind of like an aging number, Zane? Like we decide we have a great vintage, right? Like, let's say 2017. I know a number of Virginia wineries right now are sitting intentionally on some 2017 vintage because it was a great vintage, and so we might be holding it back for a little bit of theater to release it and have kind of a marketing event, or we might be holding it back to get it better and better so that we can affect our price. How do we, is it the same thing where you're calculating every single month what it costs to store a work in progress, and then applying that cost back to it so that at release time you have that inherent cost, and then you can just kind of say, well, I know it cost me this, so I want to make sure that I'm at least that plus X? Or is there another way to maybe calculate the value of aging a product?
Well, it depends, right? So, and I'm assuming you're talking about aging in a bottle versus aging in a barrel or a tank. So the way I look at aging in a bottle, there's two ways, right? There's the unintentional aging in a bottle because I can't sell my wine. That type of program doesn't incur additional overheads. That price of that bottle of wine doesn't grow through that process. Once it's released for sale, we generally stop adding costs at that point, with the idea that that's what it costs us. There's going to be costs to hold that inventory. If it's sort of in our own facility, it's a sunk cost, and it just is what it is. If it's in a third-party warehouse, well, we're paying for our inventory to be there. If it is a specific plan that I want this wine to age in the bottle, it then does need to get treated exactly the same as any inventory that's in a barrel or a tank, and it needs to continue to gather overheads throughout the period. So I think the distinction there is intentional plan versus, well, this is just what it is. We're trying to sell it, we haven't moved it yet. You don't want to run into a situation where, like, I release this in April, and then my wine that I sell in April, May, June, and July all have different COGS because I'm allocating overheads. It becomes way too complicated, and it just you can't make really good decisions. So you've got to make that distinction and figure out where it is from that, and it needs to be a clear plan. I also if you're release some of your wine, but you're holding some of it back, for the drama, and you want to release it 18 months from now, I generally wouldn't incur any additional overheads on that. That's more of a marketing decision at that point, rather than a specific decision around the wine. So it's important to just sort of distinguish what your outcome of holding that wine is, and then that will dictate the decision. Like I said, if it's a proper program, like we do age and bottle, well, then it's got to be treated as anything that's in a tank and a barrel, and gather overheads along the way in the same process.
Awesome. And so then I'm also going to kind of pick your brain on your 95 other clients, you know, a lot in Virginia, a lot of folks are doing events businesses and kind of separating out kind of business units within each individual winery. In terms of, you know, and I've spoke with some people who treat the vineyard separately, then they treat the cellar separately, then they treat the tasting room. They effectively sell their own fruit to their own cellar, to their own tasting room. You know, what are your thoughts there about kind of siloing each of our cost centers? And, you know, because back to Deborah Ring's original point is you have to make sure you're not losing money in the vineyard first before you start worrying about losing money in the cellar. What have you seen in terms of best practices there in terms of segmenting business and business units to attribute costs? You know, like, should your events business that sells your wine and your weddings, you know, should they be buying your wine from your winery itself, or should they be being brought back into the cost structure and your event manager being brought back into your cost of selling that wine?
Yeah, I mean, it's an interesting question, and you know, separating those business units obviously, you know, creates 3 sets of books to start with. So it does create some additional complexities. I do particularly like the vineyard being a separate entity. It makes the accounting a lot cleaner, a lot smoother, because you can create those true segregations, right? We're going to treat a vintage October to September. Those are the costs, and at some point we're going to move it, and I say move it in the light term, from the vineyard into the wine operation entity. And I like that situation where it's clean cut. You know exactly what the number is, and there's a lot of tax benefits for having it in a separate entity as well, in terms of cash versus accrual tax basis as well, depending on the size of your winery. So there's a lot of benefit from that standpoint. I know a lot of people like to keep your vineyard and your winery operation separate because, you know, if the winery operation is not doing so well, I could probably still sell this vineyard, and it's standing separate. The diligence is easier. So there's a lot of good business decisions. It becomes a little tricky in the terms of the different entities, like if they have different ownership structures. Because if they have different ownership structures, then you do need to make the transactions market related. So then the vineyard entity would actually have to sell it at a profit or at the market value of that wine. So that can create some complexity and intrigue in terms of what is that going to cost this year? What can I sell it to a third party? But it does move it out of the operations, and it allows for that segregation of costs and seeing what your direct costs are, what your direct overhead is, what your raw materials are, living in this one entity and creating it. You know, I don't particularly see a lot of where they move the selling entity into its own business. It's maybe 1 in 50 businesses we'll see that does that. I mean, I see the value in that. You generally have to sell it at some sort of market-related price, normally at FOB at that point. So there is some margin living in the operating entity. It creates difficulty, right? But at the end of the day, what you're doing is you're trying to figure out, once it gets to that event business or the selling business, what is my true margin? And if you're treating it as separate, like the true margin is going to be extremely different. And the winery, the winery operation should have some sort of profit to cover their overheads, and then the selling entity should have some of its own profits to cover its own overheads. And it's again coming down to the original point, right? We need to understand the costs to do business in each one of them. So if we know it's $10, we're going to sell it to these ones at FOB at $15. Well, I've got that $5 a margin. The event company can only sell it for $20, so they've only got $5 a margin to pay with each way. So there's a lot of benefits in terms, especially if you have individual managers running those businesses. It sort of puts the responsibility on them. Well, this is how much margin you have to play with to make sure you use that in the right way to make your business as profitable as possible.
Awesome. Yeah, that's about a perfect segue into kind of our next slide deck. But I definitely wanted to pause to see, what questions, if anybody has. Again, an opportunity to get a national perspective on what other wineries are doing from Zane. So I just want to make sure I'm pausing enough to have people ask any questions as they have them. Cool. Again, Zane, either we're doing an awesome job or we're doing a terrible job. There's going to be no in between here.
Well, there's always the case that they don't understand my accent, and every word I've said has just been lost on them. So there's always that.
Yeah, no, I mean, we got plenty of accents in the industry, so we're pretty good at getting through, especially some of these French winemakers we have. They make us work, but we get there. I wanted to jump into kind of a slide deck, and Zane, jump in as you see fit. I think that, and I've titled it "When Retail Doesn't Get You Retail." And so here's the overview of the presentation. Effectively, the Virginia wine industry has kind of understood, and we've actually, the wine board has even conducted studies to determine, kind of the success and failure of Virginia wineries. And ultimately, it is understood that on average, for the small vineyard size that Virginia wineries have, in order to successfully operate a winery, you really have to sell at retail. And so that is a pretty simple conclusion on its own right, but in digging in, it's kind of like in the costing of our inventory, it gets a whole lot more complicated. If you can say, well, I sell everything, we sell 80% out of retail out of our winery, or 90% retail of our winery. That's something that really sounds great, but are you capturing all the costs on the sales side of things? So the overview of the discussion is valuing the inventory, which Zane did a great job going through, but then also identifying your internal sales channels, and then the need to determine your profitability by that channel. And then back to Zane's original point about your costing, in order to make any good decision, you have to have that foundation of understanding your costs, so then you can set the appropriate strategy. Everything that you do from that point on is based on your ability to structure an appropriate pricing model. So if you go to the next slide, Landon, the technical term that Zane used was maximum net income, right? But essentially what I'm saying is every vintage is going to give us the most that we can make, and we know it. And when it goes to bottle, we know the maximum value of that inventory. And it's a function of what we can sell it for. It's a function of what it cost us to make it. And it's a function of the cost that we incur in selling it. So next slide. Like I said, we all know that, the 3-tier trap, right? Like, we get excited to say, well, I just sold 2 pallets of wine. But you had a sample rate of 5 to 8%. You had, some chargeback allowances. You had, some depletion allowances. And so I think as a industry, Virginia recognizes, what we'd rather sell what we have in our tasting room. We have a hard enough time holding on to that, right? We've got a very limited inventory, and ultimately, when we're selling out of our product before the next vintage, why would we sell in any other system? Why would we sell in wholesale and distribution? And so, but in the same respect, we can kind of almost become our own distribution entity. So next slide. I've listed a couple of our retail sales channels, right? So these are all different ways that a Virginia winery can potentially sell wine. We've got our walk-in traffic. We've got, a concert event. We've got a wedding. We've got a wine club event. We've got e-commerce. Every single one of these sales channels has different inherent costs in making the sale. And so, the walk-in traffic is the one that we kind of start with and have a good understanding. It costs us this to keep the lights on. It costs us this to have the tasting room associate pouring the wine. And, at the end of the year, we can average that out. When we start kind of doing some of these other things is when we start introducing additional costs and making things, a little different. So a concert event, do we bring in a band, and what does it cost to bring in that band? If we have that, how much more staff do we have to bring in? Do we have to bring in an off-duty police officer? Do we need to file additional permitting with the county in order to have the event? Do we, have all of these other things that event end up kind of affecting, what our margin is on each of those sales. Same thing with weddings. Is there, an event staffer that you have to hire? Do you have a discount associated with selling to events? A lot of times we say, oh, you buy your wine at a 20% discount. Are you plugging that in when you end up looking at what you're building out? Wine club event, same thing, discounts. E-commerce, you've got your packaging, you've got your boxes, you've got your person packing up that box, you've got your shipping. So identifying all the different ways that we sell our wine is kind of that next step in understanding your profitability of the wine that you're selling. If you look at the next slide for me, Bannon. So here's a couple of costs that you might, and I just kind of covered that. You've got your facility costs, your overheads, you've got your tasting room associate, you've got any of the other things associated with day-to-day operations. I think I largely just kind of covered this. Additional staff, food, a wedding, again, additional staff. A lot of it comes down to labor. E-commerce is one of those that really kind of will catch you up, because at what time do you offer free shipping, and on how many bottles, or what dollar value do you offer free shipping, and what does that do to the net price that you receive on that bottle? This is one that has really been impacting. We just placed an order of boxes, what we ship our wine in, and it was literally double. It's the same size we usually do, but it was just about double what it was last time we ordered. A lot of that was freight, but now our math has to completely change on how we're doing our shipping program, because now every box that we send out is nearly $3 worth of cardboard and pulp paper in order to get it to that person. So are we adequately charging that person, or are we absorbing that cost in the bottle that we're selling? And then those special offers will get you as well, where you are trying to sell off a product that maybe you have enough of, and you do a special offer, $10 bottle or $120 case, some extra special pricing on a back vintage or something like that you want to move out the door. You've now affected your average price per bottle in a pretty significant way. In the same respect, if you hit the next slide, a lot of these channels allow you to add income back in, right? So, if anybody can think of some ways to offset the expense of having your tasting room open, then all aboard, send me a message. I'm excited to hear. But our concert events, you can offset that by a ticket price. And you can make sure, you can even take that ticket price into a profit center. You also have to remember that you have marketing value associated with that concert event. And you can have people talking about coming to the winery. Not to mention, you've now extended your hours significantly, and you've got additional revenue that you can pull in as a result of being open for another 4 or 5 hours on a Friday or Saturday night. The wedding, you've got a facility fee you can charge, and a lot of times you can set it up where you're not paying the staff that's working the event. A lot of venues just have a facility rental, and then you're just selling the wine. That can work very well for you. So you can add back some of those costs associated with the increased opportunity. And the wine club member, retention. Eileen from Early Mountain was on a Silicon Valley Bank conversation, and I believe she's the one who said retention is the new acquisition. So holding on to the customers that we have is far easier than getting new customers. So that wine club event, you might be offering discounts, or you might be offering, we won't call, Mary Beth's not on the call, but we won't call it a free glass of wine, but wine club members might get a glass of wine included in their membership. How do you calculate all those bottles that are poured out that night, and how do you offset it in the value of the retention of that customer? And then e-commerce, it feels great to send an email out on a Tuesday night and wake up the next morning and have 50 orders, having not paid anybody to run the tasting room. So it offers, the opportunity to market to a much larger group of people over a extended period of time. So I bring this up because I think it's really valuable to kind of also realize that each of these channels can also have a different sales rate. So if you have a concert event, and I'm going to speak specifically to, our Starry Night series. So some of you may be familiar with the way we had our Starry Night series. We would have 3,000 to 4,000 people come through Veritas, and I've done several panels, and I've mentioned to everybody that when everything netted out there, with the fact that the amount of expense we had to take on, the amount of people we had to have working, at the end of the day, with the ones that did really well and the ones that got rained out, a lot of times Starry Nights ended up being a wash. And so we did not sell the wine at the same margin we did in our regular tasting room or our wine club or our e-commerce, but we sold a huge amount of that wine. So we stripped out, and I'm just willing to be honest with you guys and transparent with you. We would sell, pallets of wine at a less of a margin than we would like to. And then we would be looking around at the end of the year saying, well, we don't have wine available for our wine club. What are we going to do? How are we going to produce a product? How are we going to sell to the channels that we want to make sure that we're meeting our customers where our profit margin is the best, and where we're actually more in line with kind of the goals of the winery that we initially had in mind. So sometimes those sales channels can actually strip out at a rate faster than you would like them to, that is beyond the value of the wine that you're selling. So the next slide there, Dan, informants, please. So the impact of selling through your internal channels, you have your non-revenue value, right? So are you selling to the people you want to be selling to, the wine connoisseurs, or are you churning and burning through rosé for people who are dancing to 80s music? That's Starry Nights, right? And so maintaining inventory, is that sales channel stripping out your most valuable asset? It's your inventory. And are you selling a disproportionate amount in one place that's impacting your ability to sell it in the most profitable place? And then are you targeting the right wines for the right channels, and making sure that you don't lose the profitability? Again, to the very first slide in this deck, we have a maximum revenue potential from every single vintage. Making sure that you're also taking that next step and allocating through how you're selling your wines and what channel they're going through, and minimizing the expenses in order to make that sale is ultimately going to impact your profitability in the most significant way. So I wanted to, I will pause. I know I just kind of started ranting at you guys. Does anybody have any questions? I think I just saw something in the chat. Yeah, social media posts from consumers is a great, that's a great one. I'm assuming that's Eileen. So walking customers, promoting their social media and promotion using guests coming through as your own marketing tool is a great add-in value of your walk-in marketing. I'm assuming that's Eileen, and that's a great point. All of this is designed to sell more wine. So making sure that you're allocating it the right way. Next slide for me, Bannon.
Hey, George, can I just interrupt there for
Please? No, it's not an interruption.
Yeah, so I mean, what you're basically talking about there is program profitability, and I think you put a lot of really good things to think about. I think one of the things when you are looking at program profitability is sometimes not forgetting the most obvious costs. So if you have a wine club remember there's somebody that's having to put those emails together. There's a system software that needs to be used to get those emails out to the people and manage that system. Don't forget about those obvious costs when doing those profitability calculations. We always sometimes think about like, what can I see right in front of me? That there's a good chance that you might have not needed that one person, or at least a portion of their salary, if you weren't doing that program. So don't forget that. And one thing I like to tell people when they're looking at these programs as well, and you touched on it a little bit when you spoke about not having enough inventory for your wine club, is remember the opportunity costs, not just of the inventory and where you could use it somewhere else, but also of your time. And I think proprietors forget this a lot of time as well, where, hey, we're going to do weddings because they're super profitable, but actually they take so much of my time, who is the most expensive resource in the system. I forget to throw in what portion of my salary is involved in there as well. So also something that looks like it's really profitable, once you take into the cost of your time, also you go, oh, maybe that isn't as profitable as I thought it was. And, people coming to a wedding don't really turn into great, returning customers a lot of the time, but don't forget those opportunity costs. It's so important to the final profitability of any program, because everything is an opportunity cost. Every single thing that you decide to do, it could have been used somewhere else.
It's a great point. I mean, think about how many times as business owners we look up and you look at where you allocate your time, and sometimes you're spending your time doing the most ridiculous stuff that is not really driving your numbers. So maybe we can all look at that in terms of our own personal allocation of time, and program profitability is exactly what we're talking about. And so that's awesome, and thank you for that clarification of that term. So I mentioned here that if you need to make changes, now is the time. I'm kind of encouraging everyone, and it was where we kind of started at the beginning of this call, which is we're in a big time of economic changes, and I mentioned our boxes changing expenses. So we're undergoing this process right now, and really kind of saying, okay, we recognize that what we thought our cost metrics were are changing. I mean, it's like sand underneath our feet right now. And so, Bandon, if you go to the next slide, your costs are changing right now. So the 2021 vintage is going to cost, arguably with the frost that a lot of us experienced in 2020, the costs are going to look a little different because the yields are so poor in 20. But your costs in 21 are going to be very different than they were in 20. So making sure that you're going through and updating all of those inputs, and from it's not just the closure, but it's the freight that got the closure to your crush pad. So you can't rely on old models. You need to kind of make sure as 21 is heading towards the bottle, you capture the cost at the right time. I've said this a lot, that COVID is the ultimate disruptor. It's caused us to change the way we do things, and so now's the time to kind of look through what you're doing. We realized in retrospect what a drain Starry Nights was for us. The going through COVID allowed us to kind of look back at everything and say, okay, we need to make adjustment here. We actually did better in the absence of this. And so this is a chance for you to go ahead and say, okay, I want to change this. And you kind of have that opportunity because people are kind of, more accepting of change right now than they have ever been. And it's just so simple. You can't afford to lose money. Our margins aren't that great here in Virginia. And so making sure that we're pricing our wine, and Bruce Deal is making a very good point in the text, is that price is determined by the marketplace. And you can only sell wine for what the market will bear. That's exactly the point. So as much as we want to be able to say, it cost me X to make this Virginia wine, and I need to have this margin, we're operating in a very mature market. People can go to Harris Teeter and buy some very quality wine for a very inexpensive price. You can go to a quality wine shop and buy great wine. And so we do need to look at, staying within the norms of the greater wine industry. The other question Bruce brought up is, has anyone looked at the price elasticity in the context of a Virginia small winery? Short answer to that question, Bruce, is no. I think that, we're playing with it constantly. And I think that, and this is just my opinion, and I would really be interested to hear somebody else's perspective on it. I have continuously been amazed at the prices that people are willing to accept when they are buying wine here at our winery. We have never met pushback on a price increase here. That being said, when you leave here, our comfortable little bubble of our tasting room, the price competition is fierce, and the movement of $1 can affect sales significantly. So is anybody willing to jump in and just give at least anecdotal evidence of their thoughts on price elasticity in a small Virginia winery?
Feel free to come off mute if you'd like. Not willing to go there, huh?
Well, Zane, what do you think? I mean, and given your customers, do you also see kind of on the West Coast model a difference between what's being sold on premise and what's going out? Because I think, a lot of those wineries are doing a lot more wholesale business. Do you see much difference between their wholesale business and their FOB elasticity and what they sell when they're kind of doing a winery experience kind of thing?
I mean, the short answer is yes. And I have this conversation a lot of times when I speak to bankers and people in the M&A space about price elasticity. And it's always an interesting one, right? There is always a fear that the market will not accept the price. And because there's a fear that the market will not accept the price, people don't make changes to their prices, and then the costs catch up to them eventually. The wineries that we know that have a program in place where they just every year increase their prices, full stop, like it's part of their strategy, they never get pushback on price. It just never happens. The market expects it eventually, and it just becomes the norm. I think where you see pushback is where you don't really understand that you should have been increasing your prices. You think you're in a better position where you are, and then all of a sudden you have to throw a big increase at the market. The market generally doesn't like that and will push back. That being said, if you've done a good job of developing a good club, a list of people that come back and buy on a regular basis, 99% of the time, those people don't even realize there's a price increase and they just move forward. I do believe in the winery, you can get away with price increases more frequently and probably more aggressively than you would from a distribution model. Because unfortunately, what happens in the distribution model, you're not just talking about the increase that you need to take, you're competing against hundreds and hundreds of brands that are looking exactly the same. And most of these salespeople at these distributors aren't really salespeople, they're just order takers. And whatever's easy for them to take an order on is what they're going to push. So if you push a price increase, also that becomes harder for them to take an order on, so they just don't. So I think there is just more leeway, on your own website, in your own tasting room, through your own wine club to take price increases than there is from the distributor. And taking those prices at the distributor level becomes a big conversation and it becomes it's a project rather than, okay, we understand that we need to take a price increase and we'll push the increase onto our consumers. So, I mean, the general sense is that people are just scared to do it because it doesn't seem like the norm. I come from South Africa, right? In a good year, our inflation is 6.5%. Everybody gives an increase every year. So I'm used to it. So if I see price increase, I don't really think too much about it. Where obviously in the US, inflation's been really, really low for a really long time. So it sometimes, I think, inherently feels very difficult for winemakers to do because they don't feel like they're seeing those prices. Instead, these prices are slowly creeping up on you. So it just needs to be a part of your strategic plan, and to go in and we're going to increase prices, we're going to maintain profitability.
Yeah, I mean, I think that's inherently though, we're not being greedy. We're just trying to keep pace with what we have, and ultimately, I think that guides the thought process, because if you know what your cost is, then you know what you have to do in order to maintain it. And unfortunately, there are times like a 2020 when yields were so low that in order to price a wine effectively, it would have had to been an untenable price, right? Like, we were devastated by frost, and we still had to kind of do everything we did, and our per bottle cost was through the roof because so many of those overheads remain the same, so many of the other pieces remain the same, and we're not going to be able to say, well, here's a bottle of Viognier and it's going to cost you $45, $65, or whatever it is. What do you see happening in those contexts when people have a SKU that they want to maintain, but they don't have the ability to really cost it out the way they want to in the greater program, over a period of a handful of years? Having one bad year like that, how do you manage through that scenario? What do you see people doing there, Zane?
Yeah, so I think it comes back right to the beginning, and pricing your wine at the right place to start with is so important. Because if you price it correctly and you're making in a normal year a really the right margin, you're able to sort of have those poorer years where you can sort of absorb those lower margins in that year. And then you can sort of make the decision, am I happy to sell this because people want it and I'll just take the lower margin? I don't affect my selling price at all. Or is it a case where you make a decision like, well, this margin's too low, I'm just going to, dump it, sell it as bulk somewhere along the line, just get rid of it. It's the people who have set the prices correctly can take those bumps, and it's going to be years like that, right? Like when I spoke about the material costs, the grapes, your farming costs can stay the same every single year, and then it just comes down to yield. So you have a bad year, well, that wine's going to cost you a little bit more. But if you've done the right process up front and understood what you can sell that wine for, so that you understand what you need to spend manufacturing the wine, you should be able to take those bumps in those low years. You spoke sort of about one of those strategies where like, hey, maybe that product is low, I can maybe age it a little bit longer and I'll release it so as a slightly different product, and maybe I can put a bump in price. It's a way that I've seen people strategize as well. Like, I sell this product every single year, my crops are really low, so instead of releasing it in April, well, I'm going to wait 12 more months and get bottled aged 12 months approved on my label, and I'll add $5 a bottle to it and push through the extra cost. So there are sometimes those smart marketing ways. I mean, most people on this call are the creative type, so they can probably come up with a lot better ideas than me. But using those creative ways to figure out a way to sell it as something different, even when it's the same product, would normally allow you to push through an additional price that you wouldn't do in a normal year. One of the strategies, especially when there's like, it's a product where clients in California are using distribution the whole way, they might just make the products, we had low yields, we're just not going to put it out to distribution because then they can sell everything at retail price, just inherently a higher margin, so they can sort of make up for those losses on that side. So that would definitely be a way to sort of figure things out.
Yeah, I think in the chat, Wendy brought up, the classic supply and demand curve. It's a really simple way, as she said, and to discuss the 2020 vintage, there was very little of it. So the demand is high and therefore the price is going to move. I think that is an absolutely fair point. And I think that, that's one of the things that Virginia has driven a lot of prices in Virginia because of the limited supply that we have. and the high level of sales that we have, our proximity to population centers and things like that, the visitation levels that we have in our tasting room, and our ability to sell a significant amount of wines. The reality is our wines are already in our tasting rooms priced, kind of high. And the common refrain we've always heard in distribution is that Virginia wine is too expensive, and the supply is not consistent enough. I think that is tough for us to overcome, because our inputs are higher, our vineyard expenses are higher, and our ability to produce that product is more expensive than a lot of other wine regions. But we just need to flip that switch and get people seeing the other side of the demand curve, and then we can be those really small, tiny Burgundian vineyards that sell for huge amounts of money, and that's what we ought to do. So
back to my point that distributors, salespeople are just order takers, so they're too lazy to try to sell that story, and that's something you need to remember. As much as you love your product and you can tell the story, the people on the the three-tier system, they are not as bought into your brand as possible, and it does become difficult. So the whole strategy of trying to sell as much as your tasting room as possible at a higher price, that's great for a region like yourself, because it's just going to be tough. It's just so much easier for an order taker to take an order for a California wine than it is for a Virginia wine. It's just unfortunate fact.
All right. Well, I think we're chugging along. I think if people have any more questions, I think we have a great opportunity with Zane here to get some national perspective. If anybody has any additional questions, if not, we'll start moving towards wrapping it up. I will, put in a plug for Zane. I think that the opportunity for smaller wineries to have some analysis like this without having to hire somebody. Shoot, we know how hard it is to hire someone permanently full-time. So want to make sure that you have the opportunity to reach out to Zane. I'm sure he'd be more than happy to provide kind of a breakdown of his services and what he might be able to do for your winery. Because I think that we're constantly in this process and with a lot of different inputs, and it's one of those things that we all recognize inherently. We all understand how obvious these facts are, that if you're not making money on every single bottle of wine that you sell, you're going to be fighting an uphill battle. But we also get caught up in the love and the passion of the industry that we're in, and the commitment that we have to our brands, and the commitment we have to our farms, and all of those things. And so I would encourage everyone to do this for their own business. Use Zane if it makes sense for you. And this is a recording, so we will send it back out to everybody. That just popped up in the chat. And then Zane, I'll throw it to you for any closing comments, and then Lori can wrap us up.
Yeah, I appreciate that. And just so everybody knows, my client size is 2,000 to 6,000 case winery. Like, that's where the majority of it is. So we understand small wineries and their needs and how difficult it can be. And I'm always happy, you can reach out to me at any point. I'd just be happy to have a conversation with you, like, no strings attached. Our greatest mission is better accounting for everybody. And I'm always happy to have that conversation and just, talk people through things that, like, what are you missing? What could be different? And we also offer a free assessment of your accounting software as well. Just reach out to me for that at the same time. I think there's some really good points that the market does dictate your selling price, but the understanding that selling price and then understanding your costs will really help you, drive your business forward. And, I truly believe understanding that cost of your wine is going to be one big step to being a little bit more successful. So thank you all for having me today. I really do appreciate it. I'm sort of finishing up just in time for lunch, which is great, and it was good to see you all today.
Well, thank you for that. Is there any other questions? Another opportunity here before we wrap up. I will say that Zane's company is joining the association and will become a preferred partner. And we welcome him there. And so you'll be seeing him around in other capacities and seeing the name. And we will definitely send his contact information out to all of you as well. Are there any other questions? I do not see any. So with that, thanks again, everyone, for joining us. We put a link to the survey. It's very brief in the chat. It was also sent in the materials, and we'll send it again with the recording. Please take a moment to complete that survey. It really helps us with the planning future events. Make sure to register for the annual meeting and conference. It's coming up November 15th and 16th. It is going to be a hybrid event, but it's going to be located at the Richmond Marriott downtown Richmond. And we are planning 2 days of education for every member of your winery, from the cellar worker to the back office to the tasting room. Registration information can be found at the website at vawine.org. We are going to have our Governor's Cup tasting. It will only be available to those folks in person, and we are running an early bird special right now, so make sure you register soon. We also have the Legislative Summit coming up. We've got some building code issues that have presented themselves, and we need to talk about further, and we need to continue our conversation from the last discussion that we had. So be sure to register for that. That is free. And we hope that you'll join us for those events. And thanks again, Zane. We really do appreciate it. And George, for all of your time.
Awesome. Thanks, everybody. Have a great day.
Have a great day.
Thanks, everyone.